For real estate investors, a question they often ask themselves is, "What's the vacancy rates?" I'm not, I don't use vacancy rates a lot to make a lot of my decisions, so to speak. But vacancy rates for the average person is important. They're thinking about what's the vacancy rate right now. Is it trending up? Is it trending down? What's happening? Now, Canada, for many, many years, Patrick, has had really, really low vacancy rates. And that's the other thing to kind of warn people here is you never want to look at vacancy rates across the country. You even don't even want to look at vacancy rates in that particular province because you're investing not in a province, you're investing in a region like Peterborough, Abbotsford, Calgary, Thunder Bay, Sudbury, whatever the case may be. You're investing in a region. You got to look at what's happening in that particular region. But we do have this great chart, Patrick, that goes back to 1971 with the vacancy rates all across Canada. And kind of we're looking at Canada as a whole. We're looking at Calgary. We're looking at Montreal. We're looking at Toronto. We're looking at Vancouver. And so let's get into this because I do think it's a great chart. And it really shows you kind of over the years where vacancy rate has been and where it's at today, which is, uh, an all-time low. But it's not the first time it's this low for many of these places. As you can see, we've been there before. All right, folks, here's what we're going to do. For everybody who likes and subscribe this week, Patrick is going to do 5 push-ups for everyone who likes and subscribe. So let's jack it up. And then, Patrick, I want you to post on YouTube all the push-ups you have to do.
Okay, done. I'll even put it on Instagram because I'm into the physical challenges these days.
Like, subscribe.
Comment.
Yeah.
We have been there before. What's interesting about all of this, JG, is that, the headlines are about vacancy rates. I can't find this. We can't find a place to live. 25 students living in this place. We are flooding the country with immigrants. And so we know we need immigration. What we don't need is out of control immigration. And that's what's happening right now, from international students to temporary residents. I mean, it's like we've got this flood of people coming in. This was the easiest call that we've ever made. Yet it seems like not a lot of people saw this one coming. And we keep going back to fundamental. You and I talk about this from a real estate investor focused point of view, which is simply to say this: you've got a lineup of people that need a place to live. That isn't going away anytime soon. If they cut immigration in half, we still have this. So from a business point of view, we go, okay, well, we're opening up this business called rental property. Oh, good news. We have a lineup of people who want to rent it. That's the fundamental of what we need. We need the revenue side of things because we look at, well, we can't get financing. It's the cost of housing, all the rest. We've got all of that. But on the other side of it, we do have math that says you've got a lineup of people. So if you get focused, get your demographic, get the right region, look for the right deal because there are deals out there, certainly not in the single family detached world, but some old single families that can be converted, to a duplex, for example. Lots of challenges, but also lots of opportunities in the development side of it. There's a lot of deals out there if you're willing to look for the deals. And I go back to the fundamental. Vacancy rates are going to continue to remain this way for a long time because people are spreading out across the country looking for affordability, by the way. Aside from jobs, they're looking for affordability.
It's interesting, Patrick, because vacancy rates, as we know, a lot of investors are curious about this, but it's not just vacancy rates that investors should be concerned about and questioning and asking. It should also be rents. Where are rents going and how strong have rents been? And again, what rents do, like who cares what the rents do in GTA or in Toronto if you're investing in New Brunswick, for example? Like you really got to consider that you got to look at the rents of your particular market. And this here is this is CMHC in general. So they look at the market across Canada. But in general, very, very strong rents, Patrick. As you can see from this chart, rents have always gone up, which I find very, very interesting. Some years, 1%, 2%, 3%, which by the way is still very, very good, good growth. But look in the last couple of years, Patrick, 7%, 8%, over 8% in 2023. Rents have gone up. So rents are on fire, which, exacerbates these kinds of things, this chart. And I just want to say one last thing about this chart before we move on. And that is, look in most markets are the most volatile market is actually Calgary on this chart. Now, by the way, this chart doesn't show all the markets, so I'm sure there's markets that are more volatile. But it's interesting because Calgary is the real outlier here, right, Patrick? Where the vacancy rate goes really, really high, and then goes really, really low, and then goes really, really high. And it's interesting because you actually warned about this for the Calgary Edmonton condo market specifically in our last episode. I think it was episode number 31. You warned about this, and this is again a chart showing that this does happen in Alberta.
Well, 100%. And a lot of it has in the past been driven by oil. And right now, oil's been very strong. We're record production in Alberta. So we can continue to see a lot of people flooding into that. And the diversity, number one, of the province now beyond oil, the quality of jobs that are there. And by the way, the market isn't humming along, or the job market in Calgary isn't humming along at this crazy pace. You know, when you look at unemployment, I think the unemployment rate in Alberta right now is about 6.3% or something along that line. But the thing is the cost of living is lower. People are moving into that province. That's a lot of what's driving rents. And let's go back to rents a little bit. You know, you look at the chart that shows the spike in rents. There's a couple things that we can't overstep, and that is this. Part of our CPI basket, rents and the cost of living in terms of housing. So the interest payments on housing, part of the CPI basket. Rents, part of the CPI basket. And what's driving rents? A lot of what's driving rents, aside from rising costs, by the way, which are not out of control, they're definitely up, is what? Interest rates. Landlords have to, or rental housing providers have to raise rents to accommodate the fact that interest rates are far higher. So when we look at this whole picture of what's happening on the rental side of it, we're hitting the ceiling of limitations. So rents don't go up every month. You know, it's like they pull back, they pull back, they go up, they pull back. And all to one fundamental thing. CPI, when we look at the basket of CPI, JG, and this is where the Bank of Canada, we go back to interest rates, they're pushed because if you take out the cost of shelter out of CPI, or even get it back to where it was, our inflation is about 2.4%. That's the math.
That's fascinating, and I think you're starting to see that. We're going to see that picture play out throughout 2024. Here's another great chart, Patrick, that looks at the GTA purpose-built rental. This is average rents versus vacancy rate. So you can see average rents have come down a little bit from about $4.25 a square foot. They've come down to about $4.10 a square foot, roughly, based on this chart. And vacancy rates have ticked up a little bit. Just fascinating, Patrick, to see that this is, and we've talked about this again on the last episode, where in many places across the market, rents are just starting to hit their peak. I mean, they've gone up a lot. They've gone up a lot in the last 2 years, and they've continually been strong. But I've definitely felt it across all the markets I operate in. We've hit a peak. We've had to pull back $50 here, $100 there, so on and so forth. And as the average investor, I hope they're not thinking like, oh no, rents are going down. Rents are not going down. They've just gone up so much. They can't go up forever. We got to take a breather here. And I think you're going to see that definitely until this summer. We'll see how long it lasts.
Yeah, and there's another aspect of this. This goes back to what I said a little bit earlier, which is that rents just don't always go up forever. They pull back, they go up, they pull back. But in the case of the GTA, what you're seeing is that a lot of that rental condo market has come online. So there was a lot of completions recently. So we are starting to see, some would call it a glut of condos on the market. So that, in fact, spreads out and says, okay, now we have to compete for whatever rental market there is. And so a lot of individuals, to get things rented out, given the costs, many of these guys didn't plan on renting it out. Actually, they had planned on selling. Now it's having to rent. So they're being competitive. I want to get some money to support this so I don't have to carry the full load. So that's the competitive market of rents there.
And you can see here on this chart, folks, like in 2023, there's been, especially in the Q4 2023, there's been a lot of construction starts. That's all going to start hitting the market. And like you said, Patrick, these are, if some of these rentals, some of these condos, if they are, and that's the thing, if the condos do get sold, they often do get sold to, not always, but often there's a good chunk of them, 25% or so, that do get sold to investors, which then end up on the rental market. Those that don't get sold, the developer hangs on to them, puts them on the rental market as well, right, Patrick? So when a tower goes up and it's got 500, 600, 700 units, I mean, you could be hitting, you could be putting 25 to 50% of those units on the rental market. This has an impact on rents. This has an impact on vacancy. So investors should look to time and consider that timing as an important part of their business.
Well, I want to keep linking us back to the confusion that the Bank of Canada faces, and that we as investors, and why anybody who's trying to forecast interest rates right now, it's all just a guess. You may as well throw a dart up against the board and see what sticks, and then pick that number, because ultimately, the Bank of Canada doesn't even know what they're going to do. When we go back to this particular market, which is going to be interesting, so let's just put a stamp on this one. You've got this kind of a lot of completions coming onto the market in the condo market. You've got interest rates that are high, so developers have said, nope, I'm touching the brake. I can't make these deals pencil. They don't make sense. You've got a lot of developers and right now that are actually trying to they're giving incentives. They're not blowing it out price-wise, but they're giving a lot of incentives, lots of value adds to any given project. But here's the thing. They've quit building. They want to get rid of this inventory that they've got so that they can get financing, so that they got cash flow. So the lag of this is going to be this. They've quit building, and then you're going to see a shortage probably in 2 years' time. So this will, by the way, for those who foresee the future, what this is going to do and anticipate that kind of theory to be true, if you will, that thesis to be true, a lot of people are going to start getting into what? The pre-built construction world again, anticipating that in 2, 3, 4, 5 years, that market's going to recover. So it's just a game that you have to really stretch mentally and look at the economic data and see into the future. But this literally could lead to a huge shortage in a couple of years from now because of the immigration, the slowdown in building. Once this inventory gets cleaned up, game changer.
Patrick, you're going to be a genius once again with that prediction. That's a Patrick prediction there, folks. So remember that one. Last chart on rents, Patrick, before we move on, is this one here. You could see all the major markets across Canada, from Vancouver to Edmonton to Calgary to Toronto, Ottawa, Montreal, and Canada as a whole. How much this is 2-bedroom purpose-built apartments. How much they went up. First of all, notice how much they went up in October in 2022, October of 2022, and then notice how much on top of that, how much they went up in October of 2023. And the outsized performer there is obviously Calgary, but every single market, Patrick, across the country has been on absolute fire from that perspective. And that's a big reason for that is because how unaffordable it's become to purchase. People have to rent. They don't even have a choice anymore. And that's important. In fact, anecdotal discussion, I was talking to someone just yesterday about a rent-to-own program. And they were saying, listen, I crunched the numbers. And if I bought this property here, I would actually save $600 to $800 per month compared to my rent, and I would own it.
Wow.
Just imagine that, right, Patrick? I mean, that's the reality of what's out there. And again, that's the challenge and the difficult part the Bank of Canada has put themselves into is a lot of people want to get back into that purchasing mindset. And as they start to lower those rates, there's going to be a slingshot effect in the real estate market, I believe, and it'll be interesting to see how when it rolls out, not if, but when it rolls out.
Well, there's a fundamental here that, JG, we have beat this drum to death. I mean, I don't know, like for the past 3 years, for sure, 2 years, 4 years, I don't know, I've lost track. As real estate investors, we have to get out of the fray, the headlines. They're speaking to first-time or next-time home buyers, the retail market. We have to look at it through a set of investor eyes, if you will. And so we go back, we've been talking about rents will continue to rise, will continue to go up. Don't let the interest rates, the financing, don't let it stop you. Yes, it's harder. Got it, 100%. I'm not suggesting for a moment that it's easier. But when we look at the model and saying, why does real estate work? It works and it continues to work. Number one, there's deals out there. Number two, there is cash flow opportunities, but you have to dig for it. And what we do know is that rents will continue to tick up, given what we've got going on with the actual demand side of the equation. And ultimately, rates, even if they don't come down, they'll stay the same. This is getting normalized, and that's fine. Everything will normalize to this if rates don't come down.
Well, what's interesting, Patrick, and that's a very interesting point, talking about the normalization. We talked about that a couple episodes ago. But what I find fascinating here is there are many investors, hopefully none that watch this show. Hopefully everyone watching this show are taking action, moving their feet, crunching the numbers. But a lot of investors, Patrick, have just put up their hands and said, listen, the numbers don't work anymore. And they've stopped running the numbers. They just assume they don't work anymore. Oh, I can't make anything work at these interest rates. That's not necessarily true. I've showed you many times, Patrick, several deals I've done in the last couple months where the numbers are better than they've been in a long time. They're better right now at these interest rates. Imagine when interest rates starts to come down, they're only going to get even better and better and better. But that's only if you get in now, because as interest rates come down, the price of real estate is going to go up, back up to some other numbers, and that's going to make the numbers different again. The point I'm making there, Patrick, is a lot of people have thrown up their hands and they've made the wrong assumption, and the assumption is nothing works anymore. And that is not true. We've seen a lot of fantastic deals. So we urge people to stay in the game is the bottom line.
Well, let's go back to something. We don't sell real estate. We're looking and supporting investors to grow a portfolio, to look at future, financial gains. And if you're pragmatic, if you have the knowledge, if you have the understanding, it is in amongst this chaos that there is the opportunity. And psychologically, it's tough, JG. I look at how much research that I'm doing, how much negative stuff I'm looking at. It's really hard to get out of the fray. It's hard to get out of the mindset that the world's coming to an end, especially when you're looking at the global macro. These are the opportunities to stay pragmatic, stay systematic. We're not selling real estate. We're actually looking and saying, this is still an opportunity for you to gain the education, look at the data, make good decisions, and grow that financial future, given what's going on in the world. As a matter of fact, if you're sitting on the sidelines, what are you doing with capital? How are you putting it to work? This is an opportunity. You just have to engage. If you like what you learned here, go to the description below and subscribe for our free Insiders newsletter, where you can also stay up to date for our upcoming events and our courses.
If you want to see more stuff like this, click here. If you want to see the entire show, click there.